All right, welcome to your deep dive. We're digging into the latest earnings call from Agilysys today. That's AGYS, covering their fourth quarter and the full fiscal year that ended back in March 2025.
Right. And our goal here is basically to unpack it all, pull out the key takeaways, and figure out what it all means for you.
Exactly. So looking at the big picture first, it seems like Agilysys finished fiscal 25 pretty strong. Lots of momentum.
Definitely. They reported record financials, Q4, full year, across a bunch of different metrics.
And profitability looked good too. Better than expected.
Yeah, ahead of expectations on that front. So the overall vibe from the call was, pretty positive, strong performance, optimistic outlook.
But they did mention some challenges, right? Operational stuff, macro uncertainties.
Yeah, they acknowledged those.
Yeah.
It wasn't all sunshine and rainbows, but the core message was definitely one of strength and continued progress.
Okay, so let's get into the numbers. That's usually the best place to start.
Absolutely. Performance metrics first. Revenue for Q4 fiscal 25. A record, $74.3 million.
74.3, and the growth.
Up 19.4% compared to the year before. And get this, it was their 13th consecutive quarter of record revenue.
13 quarters. Wow, that's quite a streak.
It really is.
And the full year, how did that look?
Also a record, $275.6 million. That's up 16% from fiscal 24.
Okay, and didn't you say that growth happened even though their one-time product revenue actually went down?
Exactly, which really tells you how strong the recurring side of the business is becoming. That recurring revenue grew 26.3% in Q4.
26%.
And 23.2% for the full year. Hit $170.1 million in total recurring. That shift is central to their whole story right now.
And within recurring, the subscription piece really stood out, didn't it? Especially in Q4.
Oh, absolutely. Q4 subscription revenue was another record, $29.8 million.
29.8. That's a huge jump year over year. What was the percentage?
It was up 42.7% year over year. 42.7.
Ah.
Yeah. And it made up 64.4% of their total recurring revenue that quarter. Another record. Q4 saw the biggest absolute dollar increase in subscription revenue they've ever had.
So that subscription engine is really firing.
It is. And for the full year, fiscal 25, subscription revenue was also a record, up 39.5% year over year. This is now the fourth year in a row they've grown subscription revenue by at least 27% overall and 25% organically.
Okay. Impressive consistency there. What about services revenue?
Also strong. Record $17.8 million in Q4, and it grew 27.7% for the full year. So you just see this clear acceleration and shift towards these, more predictable recurring streams.
Makes sense. Let's talk profitability then. Gross margin in Q4 was what, just over 60%?
60.7% in Q4.
Right.
Now, that was actually down slightly from the year before. They said it was due to product mix within that specific quarter.
Okay, but the full year margin was better.
Yeah, for the full year, it improved. Came in at 62.4%, up from 60.7% the year prior.
And the driver there was that shift to recurring revenue you mentioned. Higher margins on subscriptions.
Exactly. Recurring revenue has better margins, generally. And since it became a bigger slice of the pie, 61.7% in fiscal 25 versus 58.1% in 24, it just naturally lifted the overall gross margin for the year.
Okay. What about operating expenses? Things like R&D, sales and marketing, G&A?
Well, here's where you see some efficiency gains. Those combined operating expenses, if you exclude stock-based comp, actually improved as a percentage of revenue.
Okay, so they grew revenue faster than those costs.
Right. OpEx was 41% of revenue in Q4, down from almost 44% the year before. And for the full year, it was 43% versus 45.2%. So yeah, definitely showing leverage as they scale.
Got it. Any specifics on which expense lines improved?
Product development was down to 19% of revenue for the full year. G&A was slightly down. Sales and marketing also decreased a bit as a percentage of revenue.
And this all flowed through to the bottom line. Operating income, net income.
Yep. Reported operating income, net income, and earnings per share for Q4 were all up year over year.
And the adjusted numbers.
Adjusted net income and adjusted EPS also look good compared to last year. And adjusted EBITDA, which is kind of a proxy for operating cash flow, that was $14.8 million in Q4.
Okay.
For the full year, it hit $53.8 million, and that actually finished ahead of their original plan, landing at 19.5% of revenue. So solid bottom line progress.
All right, so the numbers paint a strong picture, especially that recurring revenue growth. Let's link that back to the business momentum and this transformation they kept talking about.
Yeah, fiscal 2025 was apparently a record global sales year overall for them.
Across the board.
Seems like it. Records in international regions in their key verticals like gaming, casinos, hotels, resorts. and just overall domestic sales in North America.
And specifically for the subscription software.
Definitely a record year for subscription software sales and for services sales too.
SaaS being software as a service, the cloud model. And wasn't there something about property management systems, the PMS side?
Oh yeah, huge strength there. PMS and the related add-on modules. Sales were up 58% compared to their previous best year. And that's excluding the contribution from Book4Time, the acquisition.
58%, that's massive growth for a core product line.
It really shows the traction they're getting with that part of their platform.
Yeah.
And Q4 itself, the January to March quarter, was their best sales quarter ever, period.
Best ever.
Overall, yeah. And also best ever for North America, domestic, best ever for international, and best ever for those subscription software and services sales categories.
So momentum really picked up towards the end of the year. What about point of sale, POS? That's been a tougher area for them historically, right?
It has. But POS sales in Q4 were actually the best they had all fiscal year.
Yeah.
Significantly higher than the quarters before it.
Okay.
And managed food services sales also had their best quarter in Q4.
Okay, so improvement there too. Didn't management use a specific phrase about POS, something like turn the corner?
They did. Yeah, they explicitly said they believe they've turned the corner and are past the recent POS sales challenges.
What makes them say that? What's changed?
Well, they said implementations of their new unified POS platform are going, and I quote, exponentially better than they were before.
Exponentially better. Oh.
And they've got over 150 customer properties now actually using that new platform. So it seems like that transition, while maybe tricky initially, is really starting to smooth out and gain traction.
That makes sense. Getting past those implementation hurdles is key. You also mentioned strength in add-on sales earlier, selling more stuff to existing customers.
Yeah, that was another highlight. Sales of new products to properties that already use at least one other Agilysys product hit all-time highs in Q4 and for the full year.
How much higher?
Over 50% higher than the previous record year for those kinds of sales, which is huge because selling to your existing base is generally more efficient, right?
Absolutely. Lower cost of sale. Why are customers buying these add-ons, though? What's the draw?
The message was that customers are seeing real value in having an integrated ecosystem of modules, especially around the property management system. You know, when everything talks to each other smoothly, PMS, POS, spa booking, whatever, it brings operational efficiencies and helps improve the guest experience. Buying it all from one vendor simplifies things.
Right, the single pane of glass idea avoids integration headaches.
Likely.
Okay, so strong current sales. Is there anything indicating this momentum can continue? What about the pipeline?
Yeah, they talked about the pipeline. Their global Demo Plus stage pipeline. So prospects who were pretty far along is at a record level. It was up 18% year over year at the end of March.
18% growth in the late stage pipeline. That sounds promising. Was that across both POS and PMS?
It was. 16% growth for POS opportunities and a really strong 32% growth for PMS opportunities in that stage.
32% for PMS. Wow.
Yeah. And they also said their win ratios are getting better once customers get to that demo stage and really understand the whole ecosystem, including some of the newer stuff like AI-based upselling tools or conversational ordering.
And win rates are even better with existing customers, right? Tying back to the add-on sales.
Exactly. Much higher win rates when they're selling additional modules into their installed base.
So it really feels like the investments they've poured into modernizing the platform and building out that ecosystem are starting to generate real returns. They talked about a transformation.
Absolutely. They put some numbers on it too. Over just the last 3 years, since March 2022, annual revenue is up $113 million. That's a 70% increase.
70% in 3 years.
And subscription revenue, even more dramatic, up $60 million, which is a 130% increase over that same period.
Incredible growth on the subscription side.
Yeah, and management's quote was something like, "We believe we're only getting started now." They clearly see themselves as having shifted fundamentally to a cloud subscription-based software company.
Away from the old perpetual license and hardware model.
Right. And they said over 1,300 installations out there now only use their modernized solutions. So that base of customers on the new platform is growing rapidly, which fuels those add-on opportunities we talked about.
Okay, quick check on financial health, cash position.
They had $73 million in cash and marketable securities at the end of March. That was down from about $145 million the year before.
Okay, where did the cash go? Was that the acquisition?
Primarily, yes. The $100 million acquisition of Book4Time back in August was a big chunk. And they also drew down $50 million on their credit revolver, their line of credit.
But are they paying that debt back?
They are. They paid off $26 million of that revolver by the end of March, and they mentioned they'd paid off another $12 million since the fiscal year ended. So they're already deleveraging.
Good to hear. What about free cash flow? How's the business generating cash?
Free cash flow actually increased for the full year. It was $52.3 million, up from $40.1 million in fiscal 24. It was a bit less than adjusted EBITDA, mostly due to CapEx, investments, but offset a bit by working capital timing. They basically said both free cash flow and adjusted EBITDA are good ways to track the underlying health of the business.
All right, makes sense. Let's pivot to the future then. Guidance for fiscal year 2026. What are they forecasting?
Okay, for fiscal 26, they're guiding to total revenue between $308 million and $312 million.
308 to 312. And crucially, that guidance excludes any significant revenue from that big Marriott PMS project, right?
That's a really important point, yes.
Yeah.
Explicitly excludes any material subscription revenue from Marriott in FY26.
Okay, so within that baseline guidance, what's driving the growth?
Subscription revenue is expected to grow 25% year over year.
25%. Still very strong.
It is. Now, they did clarify that includes about 4 months of benefit from the Book4Time acquisition being in for the full year. So organic subscription growth is projected closer to 22, 23%. Still very healthy.
Right, and professional services.
Expected to grow in the 5-10% range.
Okay, so add that all up, and total recurring revenue should grow around 15%.
Roughly, yeah. Around 15% growth for total recurring.
And the one-time product revenue line, still shrinking as a part of the mix.
Pretty much flat, maybe slight growth. They guided to 5-10% growth over FY24 levels for that line. But yeah, it's much smaller now, only about 15% of total revenue, down from 25% a few years back. They expect it to kind of stabilize and grow single digits going forward.
Okay. And profitability guidance for FY26? Adjusted EBITDA margin.
They're guiding adjusted EBITDA to be 20% of revenue for the year.
20%. So that's a slight step up from the 19.5% they just finished at FY25.
A moderate increase, yeah. Suggests they're still prioritizing investment.
And they were pretty explicit about that investment strategy, weren't they?
Very. They listed all the areas: info security, product development, cybersecurity, sales, marketing, services, support, cloud infrastructure, AI, basically investing across the board.
And the rationale was?
They said they're not going to sacrifice medium and long-term growth potential just to boost short-term profits more aggressively. The goal is disciplined growth, steady profit increases, but alongside ambitious revenue plans.
Makes sense for a company in this phase. Did they comment on the macro environment?
They acknowledged some caution, especially looking out to the second half of fiscal 26. But overall, they sounded quite bullish on their own prospects despite that.
Why the confidence?
A few reasons. One, they're still relatively small in a huge addressable market. Two, the progress they're making with the modernized solutions. And three, they believe their integrated cloud ecosystem gives them a real competitive advantage that's hard for others to copy.
Okay. Anything else noteworthy on implementation or strategy? International.
On implementations, they noted most are done internally because the platform is complex and evolving fast. Migrations from older versions are accelerating, but ultimately the customer controls the pace.
So they can't just force everyone onto the new stuff overnight.
Right. They encourage it by focusing enhancements on the new platforms, but it takes time. Internationally called a huge growth area. Still relies a bit on landing those home run big wins, but progress sounds good. Existing international clients are spending more. The tech is ready. Now it's about expanding presence.
And the Book4Time acquisition, how's that integrating?
Sounds like it's gone very well. Added talent, a good spa-ness products, respected brand, global reach. The core spa business is doing well.
And the cross-selling potential. Book4Time team selling Agilysys products.
That's just beginning, they said. But they expected to make a, quote, reasonable difference in fiscal 26, as they originally planned. It adds muscle to their hotels and resort sales team.
Okay. And the elephant in the room, the Marriott PMS project, what's the latest there? Still excluded from guidance, but any updates?
Yeah, quite a few qualitative updates. They said the project continues on its planned path, good progress. Testing is going well, including complex ecosystem testing with other vendors involved.
So integrations are working. Seems like it. They said they're getting close to installing the first actual test properties.
Okay, that's a significant step.
It is. And they added that feedback from hotel staff who've actually seen the product has been remarkably good.
Remarkably good. That's strong language.
It is. But they reiterated it's a massive, complex project, so predicting the exact timing of material revenue is tough, which is why, again, it's out of the FY26 guidance for now. but all the signals they shared seem positive on the project itself.
Okay, so stepping back, if you were to summarize the key takeaways from all this material for someone following Agilysys, what would they be?
Well, first, the company's clearly executing on a major business transformation, moving from old tech to a modern cloud subscription ecosystem model. And the record results, especially that accelerating subscription revenue, suggest it's working. The market's adopting the new platform.
And that comment about turning the corner on POS seems important too, addressing a past weakness. Definitely. That's a key operational improvement signal. And the strength in add-on sales shows the value of that integrated ecosystem they've built. It's a good sign they can grow efficiently by selling more to their existing base.
The growing pipeline also suggests future momentum, right? Fueled by those investments in sales and innovation like AI.
Right. And the guidance reflects confidence in continued double-digit growth, even if margin expansion is moderate because they're reinvesting heavily. That seems like a conscious strategic choice.
And that decision to exclude Marriott from the FY26 guidance is crucial for how you interpret the forecast. It highlights the potential upside if that project ramps faster than implicitly assumed, but also shows management being appropriately cautious.
Exactly. Any significant Marriott revenue in FY26 is likely pure upside relative to their current guidance. The overall picture is of a company maybe hiding in plain sight a bit, building a defensible position in a big market with room to grow, especially internationally.
Okay, that sets the stage nicely. Let's transition to our, let's call it the outrageous but plausible trade idea segment. This is not financial advice. Just to be crystal clear, what follows is purely speculative thinking based on interpreting the call commentary. It is absolutely not financial advice. Do your own research, consult professionals. This is just an idea, a thought experiment.
Right. So building on that Marriott discussion.
Yeah.
Imagine a highly speculative play focused almost entirely on the timing and scale of that specific PMS project. Forget the baseline business for a moment.
Okay, how would that work?
The idea might be something like this, using long-dated, out-of-the-money call options. So betting on a significant stock price increase.
Long dated, meaning expiring maybe late fiscal 2026 or even early fiscal 2027, giving the thesis time to play out.
Exactly. And out of the money means you need a substantial move just to break even, so it's inherently high risk. The core bet is that despite management carefully excluding material Marriott revenue from FY26 guidance, the project actually progresses faster than the market currently expects. Maybe those initial test properties go really well, and the broader rollout starts hitting scale sooner than is priced into the stock today.
And the rationale for even thinking this might happen comes from those positive qualitative comments.
Precisely. You heard the language. Planned trajectory, testing going well, remarkably good, feedback getting close to test installs. That all sounds quite optimistic about the project's execution.
It does contrast with the very conservative financial guidance regarding Marriott.
Right. So if that project does ramp up quickly after the pilots, even getting a partial year of significant subscription revenue from a customer the size of Marriott, well, that could completely change the financial picture for Agilysys.
Revenue profitability could lead to a major re-rating of the stock that the current guidance just doesn't account for.
Exactly. Now, why is it outrageous? Because you're ignoring current valuation metrics. You're betting purely on the timing of a super complex software rollout, and you're relying on interpreting commentary that management explicitly downplayed for the near-term financials. It's a gamble on timing.
High risk indeed. But why plausible?
Plausible because the positive commentary does sound genuine regarding the project's progress and potential. It suggests the main risk might be when the revenue hits, not if the project will ultimately succeed. You're not betting the whole project fails. You're betting it succeeds faster than the conservative forecast implies.
So it's a directional wager on a massive catalyst potentially arriving sooner than expected.
A highly speculative one, yes. Again, just a thought exercise, not advice.
Understood. Okay, let's recap the main points from this deep dive into the Agilysys earnings material. They closed fiscal 25 on a high note. Record results, clear progress, and shifting to a cloud and subscription model.
Yep. They seem to have addressed past POS issues. The integrated ecosystem is driving add-on sales, sales capacity is up, and key projects like Book4Time and Marriott look promising, even if Marriott's financial impact is still TBD near term.
Fiscal 26 guidance points to more double-digit growth led by subscriptions while they keep investing for the future, leading to steady but not dramatic margin expansion in the forecast.
That's the picture. continued growth, continued investment.
And remember, everything we discussed today is based on the earnings call material and is purely for informational purposes. It is absolutely not financial advice. Always do your own homework.
And maybe one final thought for you to consider as you digest this. If the market is valuing Agilysys based on guidance that excludes a material Marriott impact in FY26, how much is that potential upside really worth if the rollout does happen faster? It's all about that timing and scale. Something to mull over.
Great point. Thanks for diving deep with us today.